Well, we are back for another topic on Real Talk, and today's buzz, of course, is the Bank of Canada rates yesterday. And we have Michelle with us today. So, Michelle, why don't you introduce yourself and let us know who you are?
Hi, Sandra. First of all, thank you so much for having me on today. My name is Michelle Drover. I'm Vice President of Premier Mortgage Center, Atlantic Canada, and also a mortgage broker. So thrilled to be here.
Oh, I'm excited for what happened yesterday that our rates now have they stabilized again. So, what's the buzz in the mortgage world?
We're cautiously optimistic. This is the second time the Bank of Canada has kept rates steady and the same. And the hope is that we will continue to see this trend. Obviously, we can't have interest rates drop too quickly because that'll accelerate the economy and then inflation will go up. So good news is they're staying steady, and hopefully the next move, we'll see that happen again and then eventually correlate down to the prime lending rate. But I don't see that happening until about June. The great news is, however, is that mortgage rates have dropped in the last 2 days. So we are seeing downward pressure on fixed rate mortgage terms. And so for all of us, this is very exciting news. We're looking at on an insured basis as low as a 5-year mortgage at 5.19. We haven't seen that rate in a while.
Oh my God, because I was looking at the other day and it was like 7 point something. And I'm like, wow, like that is just crazy. Like I don't ever, well, I mean, I've been doing this for 13 years and I've owned a house since, I don't know, in the late 90s. And I don't remember seeing, the high rates that we have now. So this is certainly great news. So there's just so many changes that would have came over since COVID and whatnot, trying to curb spending and trying to help with the housing crisis. And then the government came in and the Bank of Canada, and they introduced the stress test. Do you find with the rates where they've went up, were homeowners prepared for if you were on a variable mortgage, for example, do you feel they were prepared?
I don't think anybody was prepared to have 10 or more interest rate increases over the last short while. The stress test was definitely a much needed mechanism when it was introduced. Certainly when we saw interest rates during COVID drop to as low as 2%, we were qualifying people at a contract rate of 2%. That just would not have been financially responsible, if you will. So with the stress test, of course, you're qualifying clients at a rate of 2% higher than the contract rate. So we're really looking at clients, can they afford any sort of increase in their overall shelter costs? And so the good news, Sandra, is that most variable rate clients are on track. There's not a lot of delinquency. So they're doing everything within their households to ensure that increase in mortgage payment isn't really affecting their overall cost of living, if you will, in terms of not having to move. So there's a lot of misnomers out in the media, right? There's a lot of fear mongering happening.
I would say there is, because you talk to some people and there are no delinquencies. And then you talk to someone else and like, oh my God, that's all that's happening. I know down in the States, there were definitely a lot of delinquent mortgages. So you don't see that happening here at all?
We don't really. The interesting thing about the States is that obviously they have a larger capitalization in terms of money markets. And so their mortgage terms they lock the rate in up to 30 years. And there wasn't as much regulation, if you will, in terms of any stress testing. So I can see that happening in another banking system in another country like the United States, because they were qualifying clients literally at that contract rate. So what we're seeing here in Canada, and we're talking with our lenders, we're talking with the mortgage insurers, and they look at their portfolio 30, 60, and 90 days out. And so far, we are not seeing any increase in delinquencies that are more than what they were pre-COVID. And so again, Canadians will do whatever it takes to make their mortgage payments. And they're making smart decisions. And in fact, we're seeing savings going up with most Canadians.
I've always wondered this question. So I am an avid reader of All Nova Scotia, every morning. It's what I do. And I look at the foreclosures. And when I look at foreclosures, let's say within Nova Scotia, they don't necessarily happen in Halifax, but they're happening like in smaller communities outside. Is that because of the towns, because there's not a lot of industry there? Or I just like when I see them in.
I mean, that's an interesting question. I don't really have the answer. I mean, I would only be guesstimating at this point. Certainly, we've seen a lot of changes in the rural communities, people moving more towards cities. It could be due to all kinds of things. It could be due to death, illness, divorce. But certainly from our lenders' perspectives, when we, lend mortgages out on in those outlying areas, if you will, we're not seeing that data. And they may not have mortgages on these properties. It could be, again, due to estate sales or divorce, could be other variables that are in play.
Is it harder to get a mortgage in like outlying communities, let's say, a couple hours from city center?
It's not necessarily more difficult. It depends on the loan to value and the type of property. So if it's a cottage property, there's no year-round access. There's only one source of fuel, or the water is being, I'm not sure what the word is, but being drawn in from the lake, then it would be considered type 2 property. And so that is your typical cottage property. And certainly it depends on the area, the type of structure, the square footage of the property. Typically, we can still do mortgages on those properties. It just depends on where it is and what the overall details and property type is. In terms of a year-round access property, again, depending on where it is, if it's a residential home in a rural area, certainly we can do mortgages. All the major banks that we work with will lend in those areas. And then, of course, we have lenders that will work with individuals on an insured basis. And when I say insured, I mean that they're default insured. And that's through one of our major insurers in Canada. So we have 3. We all know who CMHC is, Canada Mortgage Housing Corporation. We then have Canada Guarantee, and we have SAGE, and they provide various programs to allow people to buy secondary properties. So if it's an alternative client, Sandra, meaning they don't maybe not meet the conventional mortgage guidelines, then yes, that might lead us to some difficulties in terms of geography. So as you can see, it's like, not one size doesn't fit all. There are just so many variables involved in facilitating a mortgage and an approval for clients.
Absolutely. So there's a lot of confusion over as well of gifted down payments. How is that working now for clients? Because most people can't afford some of the homes. And then you have gifts that from your parents or relatives. And is that still a big thing, or is it getting bigger?
It's actually getting bigger. I mean, we're seeing a tremendous transfer of wealth from one generation to another in Canada. And certainly, a lot of parents and or grandparents are looking to do whatever they can to help their children or grandchildren get into a property. So we are seeing that. I mean, and the down payments can be significant at times. It can be up to 5% or 10 or almost 20% of the property. Again, it really depends on the borrower and the net worth that their parents and or grandparents have. I mean, look, they're not taxed on it. So in terms of estate and probate and everything else, most people are starting to transfer their wealth, and they want to see their children and their family be able to get into a home, and one that they can afford. So we're seeing that a lot. And I don't see that going away at all. We're also seeing uncles and aunts that are helping out their nieces and nephews. We're seeing, stepbrothers and brothers and sisters helping out their nieces and nephews. And so we're seeing the dynamic of the profile is changing. And again, that comes down to the family makeup, the nucleus family and the nuclear family. And again, families are stepping in to help who they can with getting into a property.
So if I were to gift my kid $50,000, for example, to buy a house, does that money that I'm giving to him have to be in his account for a certain period of time? Or like, hey, what are the legalities around accepting a gift?
That's a great question. Certainly a gift letter is required, and the lender deems what their gift letter profile is. And we often, we give that to the clients, let them review it, get them to sign it. Depending on the level of the gift, we may need to see the asset from the giftor. We may need to see their investment statement if it's significant. It really just depends on how much that is. We do want to see it in the client or the person who's receiving the gift. We want to see it in their bank account. Now, we can see it as little as, we always want to see everything done 10 days prior to a mortgage closing. So if we can get them in 10 full business days prior to a mortgage closing, we usually get a copy of the transfer or the check. We need to ensure that it has not been borrowed. So there are certain protocols we do have to follow to ensure that that money was actually gifted and not borrowed. Now, having said that, we do have lenders that will allow clients to borrow a portion of their down payment. And as long as we can include that particular liability into their monthly costs, and it does not affect their overall capacity ratios in terms of affordability ratios, then we can also look at that. That's becoming more popular also.
How about if the money is coming from England? How long, and my aunt is in England, she's sending me some money. How long would the money have to sit into my bank account here locally in order for it to go to the mortgage?
At least 14 business days, depending on the lender and the origin of country, but most are comfortable with it being here for 30 days. And so again, there has to be a paper trail, right? So where's the money coming from? How did it get into Canada? And, again, we have to adhere to all the anti-money laundering and ensuring that it's non-borrowed funds. So there are certain rules, but here's the great thing about that is when you're working with a mortgage broker, we're able to help navigate that with our clients.
Yep. My other question is still on buying a home. You would have now like the biggest bulk of actually our homes that are selling here locally. I think there's been almost 900 single family homes that sold between 400 and 499. So back in the day, the average house price was 265, about 10, 12 years ago, and the home would have needed work. So I know now most single family homes that are under the $500,000 mark are going to need some type of upgrades kind of thing, cosmetic. Are you finding a lot of more purchase plus mortgages being done here locally, let's say within the Premier brand, for example?
Yes. I mean, you're quite right. There is some older housing stock. And let's face it, most people want, granite countertops and they want beautiful new cabinetry and their floors redone. And those are all things that definitely are applicable under the Purchase Plus Improvement Program. And so we are seeing that. We have some great programs out there. We have, depending again on the cost of the renovations and the amount, we have a few lenders that will actually go up to $100,000 in Purchase Plus improvements. And so, as you know, Sandra well know, the cost of any sort of improvement and supplies have gone up exponentially. So we're seeing that this is allowing our clients to be able to move into the home and really take 30, 60 days, get those renovations complete. And then they're quite happy there for a long time. Not only that, but they're increasing their equity substantially immediately.
So is it still, given the fact that there has been a labor shortage, right? Do you still have that period of time in order to complete the Purchase Plus? I know you just said like 30, 65 days. Is that still a thing? And is a person allowed to change that on a situational basis, depending what's happened if they can't get anybody to work?
We typically can go up to 120, so 4 months.
Yeah.
Sometimes there are exceptions depending on the scope of work that needs to be done. Now, just to clarify, Purchase Plus Improvement isn't for anything structural, right? So yes, as you indicated, it's cosmetic, right? So anything that is going to bring value to the property. Certainly windows, new roof, kitchens, bathrooms, flooring, those sorts of things. But we can go as long as 120 days and sometimes 180 days, 6 months, again, depending on the scope of work. So our lenders are recognizing that there certainly are shortages in the labor market and getting the supplies. And so things aren't as readily and people are not as readily available as they once were.
Now, I didn't listen to the full speech when it came to the Bank of Canada keeping our rates where they are. Is there another announcement that's going to come out, let's say in another 3 or 4 months?
Bank of Canada will make their announcement every month. And I believe it's the first Wednesday of the month.
Okay. And so, what do you anticipate for January? The same?
I think they'll stay the same. I really don't. Listen, the last thing we need is interest rates going up. We don't need the overnight rate going up. And if it starts to go up, it's because our policymakers, monetary policymakers, are very concerned that inflation is back on its way up. So it's really, really crucial that we just all be really patient, right? We want to see slow, consistent decisions being made. And I think that we will see it stay the course. And I'm really, I mean, look, it's very interesting, right? Because you get 10 economists in a room, everybody's going to have a different opinion. But I believe if we look at everything, we want a soft landing in our economy. We want things to be slow and consistent. The last thing we need is more interest rate hikes. And I think that we'll see in the summer, things start to potentially slowly decrease, which would be really great. And I think that's really great timing because I think there's a lot of pent up demand in the market. And be interesting. Now, I will say, Sandra, I'm a big believer that, we as individuals, we have to look at what the market is doing for us today, the current market. So not what it did yesterday, what it might potentially do, as you well know. At the end of the day, real estate is very affordable. Interest rates are still very affordable. I mean, we're not going to see those 2 and 3% interest rates that we have in the past. We're back to a normalized interest rate environment. So
you don't think we'll ever get back to 3% again?
I mean, I don't think we'll see a 5-year fixed at 3%. I've been in the business for 34 years. I remember doing mortgages at 11.75%, if you can imagine. Having said that, house prices were a lot lower. So things are relative. But I think, I'd love to see 4.39 maybe in our future, but it might be a year and a half out. Longer term mortgage rates are correlated to the bond market. So people will hear on the news, oh, the bond rates have dropped, our yields are low. That is when it correlates over to mortgage rates. And when the Bank of Canada rate changes, or there are changes to the Bank of Canada rate, that correlates over to the Canadian prime lending rate. And that's typically for variable rate mortgages and or revolving lines of credit. So no, Sandra, I'm sorry. I don't see a 3% 5-year in our future, but I think anything 5.25 and below is really great. And again, it's about cash flow really at the end of the day and the risk that you're willing to take. So I'm cautiously optimistic, definitely, that we're going to see some decrease in the interest rate environment soon.
Well, I'm going to hold you to that if that's okay.
Okay, you can do that.
There you go. Well, Michelle, I want to thank you for taking the time to sit and chat with me today. And I'm sorry that we couldn't meet in person, but I'm sure we'll do one
Next
soon.
time.
Yes,
Next time.
absolutely. Thank you.
Thank you so much, Sandra. Thank you so much.